Welcome to the NiftyNoon podcast.
Glad to be here for this one.
Yeah, so imagine watching just literally billions of dollars flooding out of the crypto market in this blind panic, right? But then, at the exact same moment, Wall Street is quietly pouring the concrete for the biggest infrastructure upgrade in DeFi history.
It's totally wild. I mean, it's the ultimate split-screen reality right now.
Exactly. And that's why this deep dive is custom-tailored for you. You know, the learner who really just wants to cut through the absolute noise of what has been, frankly, a deeply contradictory week in crypto, finance, and tech.
Because if you're only looking at the price charts, you see a mass exodus. But if you look at the actual regulatory filings and the corporate partnerships, you see this foundational permanence being established.
Right. So our mission today is to take the daily updates from our newsletter, NiftyNoon, over this past week, specifically June 2nd through June 5th, 2026, and really connect these seemingly disconnected dots.
Because the TLDR of this week's dominant theme, it's really the painful, messy, but completely necessary maturation of institutional crypto.
Yeah, the growing pains are real. And we're going to walk through this day by day, not just to read you the news, obviously, but to show you how a massive regulatory green light on Tuesday somehow directly crashed into a record-breaking multi-billion-dollar outflow by Friday.
Yeah, it's a crazy timeline. So we have to start with the foundation that was laid on Tuesday, June 2nd.
Right, the CFTC news. So the Commodity Futures Trading Commission under Chairman Mike Selig, they essentially opened the floodgates for onshore derivatives.
Yeah, this was huge. They approved the first regulated Bitcoin perpetual futures contracts trading under the ticker BTC PERP right on U.S. soil via the Kalshi exchange.
Which is a massive deal. And paired with that, we also saw this crucial no-action letter allowing a Coinbase affiliate to start routing U.S. clients to global derivative markets.
Okay, let's unpack this because I want to pause and actually explain the mechanics of a perpetual future or a perp because, you know, the word gets thrown around constantly. It really does, yeah.
So in traditional finance, if you buy a futures contract for, say, oil, it has an expiration date.
Yeah.
On that Friday, you either settle up or someone delivers actual barrels of oil to your house.
Which nobody wants.
Exactly. But a perpetual future in crypto, it removes that expiration date. You can hold that leveraged position forever, assuming you don't get liquidated. And historically, U.S. traders have had to go to these offshore, completely unregulated exchanges to trade them.
Right, which creates this massive blind spot for regulators. I mean, when American capital is forced offshore to trade highly leveraged instruments, U.S. regulators have zero visibility.
Nothing.
Exactly. They can't see the margin requirements, and they definitely cannot audit the automated liquidation engines running in the background.
And those liquidation engines are exactly why trading perps offshore is like driving a Formula One car on an icy, unlit road. I mean, it's insanely fast, but prone to catastrophic crashes.
That is a perfect analogy.
Case in point, look at that recent $1.5 million flash crash we saw in an offshore venue. If you're leveraged to 100 to 1, and the price of Bitcoin drops just 1%, your entire position is wiped out.
Instantly.
Right. The automated engine force sells your position. And that forced selling drops the market price a little further, which triggers the next person's liquidation, which triggers the next...
A complete cascading chain reaction.
Exactly. That's how a tiny dip turns into a multi-million-dollar wipeout in minutes. So are we just bringing that exact same danger to U.S. soil?
Well, what's fascinating here is that this is actually about systemic risk mitigation.
Really? How so?
By bringing this onshore, the CFTC is trying to stabilize things. They're transforming Kalshi from basically a prediction market into a next-gen derivatives venue with proper, legally enforceable guardrails.
Oh, I see. So the clearinghouse is actually subject to U.S. law now.
Exactly. The government isn't trying to encourage reckless leverage. They are demanding visibility into the plumbing before it blows up again.
That makes a lot of sense. And that visibility has to be what institutional capital has been waiting for, right?
100%. It's a massive milestone. There are compliance officers at, U.S. pension funds who simply ban their trading desks from touching offshore venues. It was just a hard no.
So this legally unlocks the door for all that domestic capital that was sitting on the sidelines.
It really does. Even if it's just agency guidance right now and not an act of Congress, it's enough.
And we actually saw other institutional signals that same Tuesday. Like Coinbase Ventures was buying Athena ENA on the open market, targeting their 100 million user base. And Polymarket facilitated the first ever on-chain institutional block trade.
Yeah, traditional finance was confidently setting up shop.
Which perfectly sets up the massive contradiction of the week. Because if institutions just got the regulatory green light on Tuesday, Why did Wednesday's headlines scream that institutions were abandoning ship?
It's such a jarring pivot. But the data from Wednesday, June 3rd, it showed the underlying market structure facing a severe reality check.
Yeah, the numbers we reported in our newsletter were just brutal. Last week, $1.67 billion exited crypto funds.
A massive hit.
Huge. Bitcoin funds bled a record $1.44 billion, and Ethereum saw over $257 million in redemptions. And then MicroStrategy. They broke their long-standing holding streak and actually sold 32 Bitcoin.
Which, okay, in dollar terms, 32 Bitcoin is around $2.5 million. For a company holding billions, I mean, it's basically a rounding error.
Right, but markets are driven by narrative.
Exactly. The psychological impact of the ultimate diamond hands corporate treasury selling anything at all, it definitely spooked retail sentiment.
But retail panic doesn't explain a $1.67 billion outflow.
No, definitely not.
So here's where it gets really interesting. Is this like moving your cash from under a mattress into a high-yield savings account? Because we noted that passive, raise-and-hold digital asset treasury inflows, due-dat inflows, they plummeted 95% in May.
Down to just $180 million.
Right, the lowest since October 2024. That's a violent rejection of the old model.
It is, because the structural reality has completely shifted. Investors are suddenly demanding capital efficiency.
Explain that a bit more.
Well, think about net asset value, or NAV, compression. In the last cycle, you'd buy shares in a proxy company holding Bitcoin, but now, with low-cost spot ETFs, those proxy shares trade at a massive discount.
So if I'm an investor, why would I pay a management premium to a company that just lets digital gold sit idle when I can buy a cheap ETF?
You wouldn't, and corporate boards know this. They realize they can't just hold anymore. They need active yield generation. They want staking rewards, DeFi yields. They want the assets working.
Which brings up the launch of Grayscale's hyperliquid staking ETF, ticker HYPG, on that exact same Wednesday, with just a 0.29% fee.
A perfect example. It proves this transition is happening. And notice that amid the $1.67 billion outflow, altcoins like XRP and hyperliquid HYPE actually bucked the trend and saw inflows.
So the market is shifting from passive holding to active yield models. But if you're running an active 24/7 DeFi treasury strategy, you need plumbing that doesn't just shut down at 5 p.m. on a Friday.
Which is the massive bottleneck with traditional banking rails.
Right. Enter Mastercard on Thursday, June 4th. They officially opened their global card settlement network to regulated stablecoins. We're talking USDC, PYUSD, and RLUSD.
And not just a tiny pilot program either.
Exactly. Across 8 major blockchains: Solana, Ethereum, Base, Arbitrum. And they have early adopters like Cross River, Lead Bank, and Nuva ready to go.
This is a fundamental rewiring of the global plumbing. Integrating stablecoins natively into a network processing thousands of transactions a second globally is staggering.
But wait, I have to ask, didn't Visa already do this back in December 2025 with Solana and USDC? Is MasterCard just playing catch-up? Or is this really a moment where we upgrade from, like, dial-up banking to broadband finance?
If we connect this to the bigger picture, MasterCard's framework is materially broader. Visa was definitely first, but they used a single asset, single chain approach. It was a proof of concept.
Oh, okay.
MasterCard coming out of the gate with 6 stablecoins and 8 completely different network architectures that creates redundancy and massive interoperability.
So this introduces intraday, weekend, and holiday settlement cycles for the first time on this kind of scale.
Yes, subject to the 2025 Genius Act frameworks. Treating public blockchains as trusted settlement rails for trillions in transactional volume is the ultimate real-world utility milestone.
And you could see the TradFi push happening everywhere on Thursday. We had pro-crypto senators publicly pressing banking regulators to establish Basel capital requirements for banks' crypto activities.
Which means they want clear rules for how banks hold these assets in reserve. They see it as a permanent fixture now.
Right. So we've got U.S. perps approved on Tuesday, active yield strategies launching Wednesday, MasterCard rewiring global settlements Thursday. The foundation looks incredible.
It does.
So why did Friday's data look so incredibly bleak? I mean, spot Bitcoin ETFs extended a record 13-day outflow streak, bleeding $4.4 billion.
It was very ugly Friday.
BlackRock's IBIT alone lost $3.3 billion, dragging BTC down towards $63,000. Solana, Ethereum, HYPE, all taking heavy daily losses. And MicroStrategy is now facing its biggest unrealized loss in history at negative $10.8 billion.
Yeah, seeing negative $10.8 billion generates some pretty grim headlines.
So what does this all mean? Citi put out a note saying there's a temporary drought of fresh buyer demand. But are we just making excuses for a $4.4 billion dump? Is this a forest fire destroying the market or just clearing out the underbrush?
This raises an important question, because when you look at the macro perspective, this isn't a permanent decline, it's a structural transfer.
A transfer from who to who?
From early holders and miners into broader institutional hands. You have to contextualize these numbers. Yes, $4.4 billion flowed out, but total net lifetime inflows for these ETFs remain over $55 billion.
Wow, okay. So a $55 billion base absorbs a $4 billion shock pretty well.
Exactly. This exhibits far greater holding resilience than historical gold product rollouts ever did.
But why sell it all right now, with all these regulatory wins?
Think about the broader macro environment. Interest rates are high, and we have this massive $400 billion AI infrastructure build-out happening right now.
Right, Michael Saylor actually mentioned this recently. He thinks these outflows are just a capital rotation into AI.
He's spot on. If you're a macro fund manager and you need liquid cash to fund data centers and chips for AI, you trim your most highly liquid, profitable positions. For many, that means selling their Bitcoin ETF shares.
Ah, so it's a temporary macro cloud masking a broadening institutional foundation.
Precisely. They aren't selling because the crypto thesis is dead. They're selling because they need cash today for AI.
That makes total sense.
Yeah.
So let's synthesize this for the listener. A rapid-fire signal versus noise breakdown for the week.
Let's do it. So the noise was definitely the panic over the 13-day ETF outflow streak. People declaring the death of institutional crypto.
And hyperventilating over MicroStrategy selling a tiny fraction of their holdings.
Exactly.
But the signal, what truly mattered, is that the underlying market structure is profoundly upgrading. I mean, from the CFTC greenlighting onshore perps to Mastercard executing multi-chain 24/7 settlement.
The infrastructure for the next cycle is literally being laid right now.
Exactly. And what to watch next is how quickly traditional corporate treasuries migrate from passive holding to active DeFi and staking yield generation.
That's the next big frontier.
Absolutely.
Yeah.
Well, thanks for joining us on this deep dive. If you want to stay ahead of these massive shifts, make sure you're following NiftyNoon on X and our Substack for all the daily updates.
And I want to leave you with one final seed to mull over. If institutions are successfully lobbying for regulated onshore perpetuals while simultaneously building 647 stablecoin settlement networks, what happens to traditional weekend liquidity?
Ooh, that's a good point.
Right. I mean, when the stock market is closed on a Saturday,
Yeah.
but the crypto market is settling billions in real time uninterrupted. Will Wall Street eventually be forced to abandon the closing bell entirely?
8247, always on Wall Street. That is definitely something to think about. Thanks again for tuning in. We'll catch you on the next deep dive.